Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Regal Rexnord Corporation Annual Report. Regal Rexnord Corporation offers a diverse range of businesses and services across various industries. At its core, the company provides sustainable solutions for power, transmission, and control motion products globally. The Industrial Powertrain Solutions segment is one of the key areas of focus, offering mounted and unmounted bearings, couplings, gearboxes, and other industrial powertrain components to markets such as metals and mining, general industrial, energy, and machinery. This segment also caters to alternative energy, discrete automation, and other specialized industries. The Power Efficiency Solutions segment is another significant area of business for Regal Rexnord Corporation. It provides AC and DC motors, electronic variable speed controls, electronic drives, fans, and blowers for various applications including residential and commercial HVAC, water heaters, commercial refrigeration, and agricultural uses. In addition to these two segments, the company's Automation and Motion Control segment offers conveying automation subsystems, aerospace components, precision motion control solutions, miniature servo motors, and power management products. This segment serves a wide range of markets, including industrial automation, robotics, food and beverage, aerospace, medical, agricultural, construction, general industrial, data center, and others. Regal Rexnord Corporation sells its products directly to original equipment manufacturers, distributors, and end users through various channels. With a rich history dating back to 1955, the company has established itself as a leading provider of sustainable solutions for power, transmission, and control motion products globally. Regal Rexnord Corp's stock price surge of over 63.14% in the past year can be attributed to several key factors. The company's robust financial performance, particularly its strong fourth-quarter earnings and data center orders, played a significant role. In February 2026, Regal Rexnord reported adjusted earnings of $2.51 per share, exceeding analyst expectations, with revenue increasing by 4.3% year-over-year. A major highlight was the substantial increase in daily orders, boosted by approximately $735 million in orders for its ePod solution, designed for data center power management. This led to a 50% year-over-year increase in the company's backlog and an optimistic adjusted earnings per share (EPS) guidance for 2026. The positive earnings report was further fueled by analyst upgrades and price target increases, with J.P. Morgan raising its price target from $190 to $230, and Barclays adjusting its target from $165 to $237. Regal Rexnord's strategic vision, presented at the Barclays 43rd Annual Industrial Select Conference, also contributed to the stock's upward momentum. The company highlighted data center growth and internal operational improvements, fostering cautious optimism among investors. Additionally, Regal Rexnord's focus on electrification and energy-efficient solutions is seen as a crucial driver for long-term revenue growth and enhanced pricing power. The company's growing demand in automation and aerospace and defense markets, strong cash flow generation, and consistent dividend payments have also contributed to its stock performance. Overall, Regal Rexnord Corp's robust financial performance, strategic vision, and focus on key growth areas have driven the significant increase in its stock price over the past year. Regal Rexnord Corporation market capitalization of $14 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Regal Rexnord Corporation holds a significant advantage in their industry. Regal Rexnord Corporation trades at a higher price-to-earnings ratio of 51 times and a lower price-to-book ratio of 2.09 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be identified through an analysis of various key aspects. One significant factor is the recognition of revenue from unsatisfied or partially unsatisfied performance obligations, which is expected to amount to approximately $955 million in the future. Segment-wise, the powertrain segment has shown a substantial increase of 37.5%, with $902.9 million in revenue growth, while the automation and motion control segment has experienced a decline of 0.9%. The power efficiency segment has also seen an increase of 16.3%. Geographically, the company's net sales have decreased in the US and China, but increased in the rest of the world. This indicates that the company is expanding its presence globally. The impact of commodity and currency forwards on revenue growth is also a crucial consideration. The company has commodity forwards of $7, $22.30, $15.30, and currency forwards of -$9.10, $31.20, $39.30, which may affect revenue growth. Restructuring expenses are another factor that can impact revenue growth, with the company expecting expenses of $26.3 million in 2025 and aggregate future charges of approximately $27 million in 2026. The use of a revenue multiplier based on 3-year revenue growth from 2025 through 2027 also plays a significant role in determining payout ranges. Additionally, the return on invested capital, ROIC, performance metric is used to evaluate the company's performance. Overall, these factors collectively contribute to the drivers of revenue growth or decline for the company. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from $646.80 in year 1 to $35.90 in year 2, and further dropped to $12.30 in year 3. However, there was a notable increase of 43% from 2024 to 2025, with the net income rising to $279.5 million. The profit margins also showed an improvement over the years. The consolidated profit margin increased by 1.1% from 10.4% in 2024 to 11.5% in 2025. Additionally, the gross and operating profit margins saw a rise, with the former increasing from 36.4% in 2024 to 37.4% in 2025, and the latter rising from 6% in 2023 to 11.5% in 2025. The reasons behind these changes are not explicitly stated in the provided text, but it can be inferred that the company's financial performance improved significantly between 2024 and 2025, resulting in increased net income and profit margins. The company's financial performance is a key indicator of its overall health. One crucial aspect of this performance is the generation of operating cash flow. Operating cash flow refers to the amount of money a company generates from its core business operations, excluding non-operating items such as investments and financing activities. According to the provided information, the company indeed generates positive operating cash flow. This means that it has sufficient funds to cover its operational expenses, invest in growth initiatives, and pay dividends to shareholders without relying on external funding sources. The confirmation of this positive trend can be found on pages 44, 45, 53, 63, 66, 70, and 87. The generation of positive operating cash flow is a significant achievement for any company, as it indicates a strong ability to manage its finances effectively. This, in turn, enhances the company's creditworthiness, reduces its reliance on debt financing, and provides a buffer against unexpected expenses or downturns in revenue. Overall, the company's positive operating cash flow is a testament to its financial discipline and resilience. The company's debt level and interest expenses have undergone significant changes. Initially, the total debt decreased by 11.6% from $5,457.7 million in 2024 to $4,788.7 million in 2025. However, long-term debt increased due to the issuance of senior notes. Despite this increase, the total long-term debt as of December 31, 2025, was still lower than the unspecified amount for 2024. In terms of interest expenses, there has been a notable decrease. Interest expense decreased by 12.6% from $349.20 in 2024 to $399.70 in 2025. This reduction is attributed to changes in credit agreements and resulted in a net savings of $50.5 million. Overall, the company's debt level has decreased, and interest expenses have also significantly decreased, indicating a positive trend in the company's financial management. The company's performance across various segments and regions has been mixed. On the positive side, the Industrial Powertrain Solutions (IPS) segment has shown strong results, as mentioned on page 37 of the report. Similarly, the Automation and Motion Control (AMC) segment has also performed well, with references to its success found on pages 10 and 37. However, there are areas where the company has struggled. The Power Efficiency Systems (PES) segment has been a particular concern, with poor performance noted in both the first and fourth quarters of the year, as highlighted on page 10 and page 37. This suggests that the company may need to focus on improving its offerings or strategies within this segment to get back on track. Management is optimistic about the company's future prospects, citing strong secular growth markets with favorable regulatory conditions. To capitalize on these opportunities, the company plans to double its new product vitality in the medium term and leverage its scale and scope to offer unique value propositions to customers. A key aspect of the company's strategy is improving business durability through initiatives such as OEM sales and new solutions, which will help increase consistency in sales performance. Additionally, management has committed to investing in innovation, including energy efficiency, embedded intelligence, and variable speed technology solutions. The company also aims to develop a high-performing organization that meets its business objectives and achieve carbon neutrality by 2032. To stay competitive, the company plans to continue developing new technologies, innovative products, and manufacturing techniques. In terms of cost management, the company expects to increase compliance costs due to new regulations and standards related to ESG and climate change. However, it also aims to make the business more efficient through restructuring activities, business optimization initiatives, and operations consolidations. Management is confident in the company's ability to fund its capital spending plans, which include investing $120 million in property, plant, and equipment in 2026. The acquisition of Ultra is expected to bring substantial revenue and cost synergies, further supporting the company's growth prospects. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its portfolio with notable purchases such as Ultra Industrial Motion Corp. in 2023 and Rexnord Process and Motion Control business in 2021. Additionally, it acquired Land Common Stock by RBS Global Inc. and a subsidiary in 2007. On the other hand, the company has also divested certain businesses to streamline its operations. Notably, it sold the industrial motors and generators businesses in 2024, marking a significant move towards focusing on core areas of expertise. Furthermore, immaterial operations were also disposed of in 2025, demonstrating the company's commitment to efficiency and strategic growth. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $93 million in 2025, with a declared amount of $0.35 per share on January 26, 2026. The payment date for these dividends was April 14, 2026. In addition to paying dividends, the company has also been active in buying back its own shares. In 2024, it repurchased common stock worth $50 million. This demonstrates a commitment to returning value to shareholders and potentially increasing their ownership stake in the company. Concerns about inventory buildup or supply chain disruption are evident throughout the extracted summaries. On page 18, inaccurate forecasts could lead to overstocking and inventory buildup, resulting in reduced revenue and working capital impact. Similarly, on page 78, a significant inventory buildup of $387 is mentioned. Furthermore, pages 16 and 23 highlight dependence on key suppliers, volatility in raw material prices and availability, trade restrictions, and tariffs affecting supply chain. These factors can lead to potential supply chain disruptions due to trade tensions between countries. Additionally, page 24 mentions the risk of labor disputes or organized labor activities causing disruptions that could adversely affect business or financial results. The sale of industrial motors and generators businesses in 2024, page 44, may indicate some level of disruption or change. Overall, these concerns suggest a need for careful management of inventory levels and supply chain relationships to mitigate potential risks and ensure business continuity. That concludes the financial summary for Regal Rexnord Corporation. Feel free to comment below, and I will be happy to answer them when possible.